Hi, everyone. We're going to get started. Thank you for joining us this afternoon. I'm Michelle Golombuski, Vice President of Development here at the Michael J. Fox Foundation. I wanted to kick us off today with a brief update on some of the latest advances in Parkinson's drug development. The pipeline of PD treatments towards a cure is full of promise, and several therapies with potential to slow or stop disease progression are in clinical trials. Leading this charge is genetics. No fewer than 8 genetic genetics-based trials are now ongoing, including 2 that launched in 2017. Studying genetic targets with a known connection to Parkinson's can give scientists a better understanding of disease biology and lead to therapies that benefit all people with PD. The Foundation is also working to advance a cure through repurposing investigations into drugs that are already approved for other diseases with the potential to treat PD. This includes drugs for cancer, hypertension, and diabetes. We are seeing tremendous movement in treating PD symptoms. 2 new Parkinson's drugs came to the market last year alone, marking 6 new therapies to better address symptoms since 2014. And just this week, an inhaled form of levodopa was submitted to the U.S. FDA for approval, the last step before hitting pharmacy shelves. This treatment aims to help decrease off times when medication stops working and before the next dosage can be taken. A decision from the FDA is expected in the fall of this year. None of this progress happens without partnership. An engaged, educated, and committed PD community is critical to all of our efforts. So we're so grateful for your support as we build on this momentum. I hope you continue to stay connected with the latest research updates on our website by visiting our blog at michaeljfox.org. You can also connect with us on Facebook or Twitter. Before I introduce today's speaker, I have some housekeeping items. If you experience technical issues, first try refreshing your web browser. You can also check that Flash Player is enabled or switch to another internet browser such as Safari or Internet Explorer. On your screen, you will also find some additional tips. If you continue to have trouble, please know that a copy of the slides is available to download on the right side of your screen, and the archived presentation will be emailed to you and available on our website. Now let's get started with the presentation. We are delighted to have our friend Marty Shenkman as our featured presenter today. He's a CPA, an attorney whose firm specializes in estate and tax planning, and author of 42 books, including one that is focused on charitable and estate planning with Parkinson's. Back in September, Marty presented on actionable steps for people with PD and their families around estate planning. And today he's sharing updates based on the tax changes voted into law at the end of 2017. Both of these presentations will be emailed to you. Now I will pass it over to Marty. Thank you for sharing your expertise with us again today.
Always a pleasure, and thank you everyone for joining. Let me just take a quick half minute and tell you kind of why I'm here doing this. Then I'd like to take a minute and explain what we're going to cover and what we're not going to cover, because I want to make sure that everybody on the call gets information that will be helpful to them. I've been a great fan of the Fox Foundation for many years. My brother-in-law had PD. My wife has MS, and we devote probably between 2 and 3 months, maybe more a year, to educating primarily attorneys, accountants, and financial advisors how they can better help clients living with chronic disease or disabilities. And over the course of the many years, I've been honored to be able to help such a great organization as Fox pursue its purposes. So that's kind of why I'm here. So I kind of feel a kinship and understanding of what is important to many of you, because it's the same issues that I and my wife face together every day. Let me talk about our program, and I want to make sure that everyone understands what we're going to do. It's a very unusual program. Typically, when I lecture or present on a topic, the program and the materials are targeted to a specific audience in terms of wealth levels, because planning can be very different at lower income and wealth levels and higher income and wealth levels. In this program, and I don't think I've ever done this in the many hundreds, if not thousands of speeches that I've given, I'm going to try to talk to all wealth spectrums. So if you hear things that are just beyond anything that's going to make sense for you, don't tune me out, because we're going to try to cover other practical planning points that are going to work for every single wealth level, from moderate to extremely high net worth. A number of the topics, especially those for higher net worth clients, donors, what I'm really hoping is I'm not going to be able to get into great depth, but that I give you a seed of an idea that you can then take these slides or the ideas and go back to your attorney, your accountant, your wealth advisor, and begin using some of the ideas to help you plan to help the Fox Foundation. So we're going to try to cover the full spectrum. I'm also concerned that because we're going to talk a little bit about estate planning, many people that are affected or touched by PD are looking for Medicaid planning because of their financial needs. It's not an expertise I have, and I'm not going to cover that. Many of you, or some of you, may have signed on to this looking for more basic estate planning for people affected by PD. And as was mentioned by Michelle a minute ago, I did a program last year for the foundation on basic estate and financial planning steps, and even not so basic, that everybody affected by PD should look at. The recording for that is on my firm website, shenkmanlaw.com. The Fox Foundation, I think, will be posting it on their website, and they graciously offered to send you a link to their recording of that when they send out a follow-up email. So if you're looking for basic estate planning and steps that you need to take to protect yourself if affected by PD, that link is what you're going to want. We're not going to really do that today. The real primary goal of today's program is to talk to you certainly about some changes to make to your estate planning documents because of the new law, but more significantly to talk and brainstorm almost with you ideas of how you can still get some tax benefit out of charitable giving and donations to the Fox Foundation in light of the many restrictions that they enacted in the new law. And I'll explain those and give you hopefully what you'll find to be a number of very creative ideas on how charitable giving should be structured. And I know on the call we also have planned giving experts from the Fox Foundation. Unfortunately, I think that the entire approach to planned giving has changed because of the new law, and hopefully this will give you a lot of new ideas that you can use to help the foundation in its great cause. So let's get started, and we're going to talk about some updates to your planning because of the new law. And maybe what I should do is just take a quick minute, and we're on slide 5 if you're following along. I want to explain just a couple of the changes that were made in the new law. I may repeat them, but the repetition may be helpful just given the complexity, because it's changed so much of planning. First change, and it's on the top of slide 5, the estate tax exemption, how much you can give away to family, loved ones, anyone you want, not charity because that's unlimited, used to be $5 million inflation adjusted. The new law doubled it to $10 million per person inflation adjusted, so the actual number is a little over $11 million. For a married couple, it's over $22 million can be transferred without any estate tax cost. And that's not counting how much can go to a spouse, because that's unlimited, or to charity, which is unlimited. So very, very few people will now be subjected to an estate tax. Number of points on that. That exemption amount will change in 2026 back down to the $5 million. It's going to get cut in half. I'm concerned that because of the incredible deficits this new tax act will create, in my view, and view of many other experts, that we could have a change well before that. It's possible we have a change in the guard in Washington in 2020, and by 2021 may see some of these changes reversed. What that means is, for many people of means, you want to plan now and use this exemption. And we'll talk a little how charitable planning comes in for wealthier donors later in the program. They also changed, which is not on this slide, but we may come to it, the standard deduction. So if you're filing a personal income tax return, they've now doubled the standard deduction that you get to take off of your income before calculating tax, from $12,000 to $24,000 for a married couple. So the good news for taxpayers is for many people, their tax return will be simplified because they're not going to have to tabulate all these complex deductions and see how much they get. And for many Americans, taxpayers, they will find their tax bills going down a little bit because of that. The negatives or problems from that, and the first point or problem is something that's really not discussed in this program, but is something that concerns me, is very few people will get a deduction for medical expenses. And for example, if you need to renovate your home, if you need to put in an elevator, if you need to tear out all the flooring in your home and put in subfloors and new floors in order to eliminate any change in gradient because of gate issues, if you want to automate your home so that you can control the entirety of your home, electronics, heating, air conditioning, and more from an iPad, for example, the cost of that used to generate a fairly significant tax deduction, may still do so, but for many people, until you get over that 24-grand hurdle, it won't. For charitable giving, for those on the lower end of the income spectrum, and it's not even that low, maybe even upper income and down, few people will get over this $24,000 standard deduction. So for most Americans, there will be no income tax deduction for charitable contributions unless you're at a high level of income and a high level of donations. So the bottom line of these two changes, doubling the estate tax exemption, doubling the income tax exemption, means that charitable giving is going to have to be different or there'll be no tax benefit for it. And we'll talk about that in a minute as well. Now, key point, second bullet point on slide 5, all the personal issues of estate planning remain. Leaving aside taxes, everything you need to do to take care of a spouse, a partner, a loved one, to take care of children, other family members or heirs, to take care of yourself, all of those aspects of estate planning remain unchanged. The prior program we did last year will go through a lot of those concepts and what you need to do to take care of yourself and your loved ones. Tax planning is a whole new world, and we're going to talk about that. So let me just give you a couple of changes quickly that are not necessarily charitable related, but just because we're talking about the new law and its impact, I just think it's important to be on the table, and it may relate to charitable giving. If you have a will or revocable trust that was done any time before this new law, you really need to talk to your attorney and make sure that it still works. The problem with how most wills were done, and it wasn't a problem when they were done, it's a problem because of what the new law did, and it's not a fault of whoever your attorney was. They were doing the best they could with the limited knowledge we had, but nobody anticipated the changes that were enacted last December 20th. We use formula clauses. So we would use a formula like you give the maximum amount that won't create a state or federal estate tax to a trust for family members. Well, when you did your will, perhaps 10 years ago, that may have been $1 million. Well, now it's $11 million. So the way your estate may get divided could be completely the opposite of what you anticipated when you did your documents. You need to go back and look at your documents and see how that works. You need to take a look at other documents as well to see how they change. So, for example, on slide 7, if you had a power of attorney, many people in the standard, very typical form power of attorney will permit gifts of up to $15,000, annual gift exclusion. Well, for most of you, if your wealth is so far below the $11 million exemption, and even if it's well below, or especially if it's well below the $5 million, which it's going to revert to in 2026, why do you want a gift provision in a power of attorney? The gift provision authorizes the person you name in this document, who you're authorizing to handle tax, legal, financial matters for you if you're incapacitated, to make gifts. But for the vast majority of Americans, the estate tax is irrelevant. The original reason gift provisions were put in all these documents is 20 years ago when we had a $600,000 estate tax exemption, a dramatically greater proportion of people were subject to the estate tax. So you may have wanted the ability to make these gifts to reduce an estate tax. But if your estate is well below $5 million as an individual and $10 million as a couple, having the right for an agent to make gifts may be a detriment, not a positive. It won't provide any tax benefit, but what it will do, what it may do, and in too many cases sadly does, is permit elder financial abuse. So if you have health challenges and your agent is authorized to make gifts, in far too many cases, that authority under a power of attorney has been abused to commit elder financial abuse. So maybe what you need to do is eliminate that. Now, for the wealthier end of the spectrum, and there's a major tax case last year called Powell, the children were trying to do planning for an elderly mother, but the power of attorney limited any gifts they could make to the annual exclusion. This year, again, $15,000. And because of that, it was the constraint that, one of the constraints that prevented the planning they were trying to do. So if you're on a higher end of the wealth spectrum, you should probably, when you revise the document, make sure that you permit much bigger gifts so that you can take advantage of this now temporary heightened estate tax exemption. Second bullet point, for everybody, most powers of attorney that I see don't permit charitable gifts. If you've been a friend of the Fox Foundation for many years and you've given donations year after year, why, if you are ill and not able to take care of your financial affairs in the future, should that giving to such an important cause to you be cut off? Make sure your document provides the ability for your agent to make charitable gifts. And while you should certainly talk to your lawyer, a very common approach is to permit the agent to make charitable gifts in accordance with your historic pattern of giving. So if you've given the same amount of dollars or it's increased to 10% a year to the foundation, that will authorize your agent to do it. And you can also address that if you have a revocable trust and the gift provisions there. Final bullet point, and this is a very significant change that everybody in planned giving, everyone who's a donor should think about. When you update your power of attorney, and I've given you some tax and non-tax reasons to do so, now I want to give you something to help the Fox Foundation and help you get a tax benefit. If your estate is well below the $22 million exemption, or is unlikely to exceed it, you're going to get zero estate tax benefit on charitable gifts. For most for the period that we've had in estate tax, for most of history, most charities have often sought out bequests. Bequests are a wonderful way to remember an organization that's important to you. When you pass and you don't have need for money anymore, it's an optimal time to make charitable gifts, and bequests are just a wonderful way to do it. The problem now is with the exemption being so high, $11 million per person, $22 million per couple, few, if any, people are going to get any kind of tax benefit. There's a simple solution for many of you. Permit, when you update your power of attorney with your lawyer, permit the agent to make advancements, that's the legal term, advancements, or prepay in English, charitable bequests. Great for the Fox Foundation because if you're not well, your agent can prepay the bequests in your will. Great for you because prepaying those bequests with some of the other planning we're going to talk about may generate a nice income tax deduction. Why not help the foundation? Why not get your deduction early and a tax benefit to boot? So again, very different perspectives and approaches on planned giving, charitable giving, and what you need to do. Another thought on slide 8. And be careful before you do it. And I want to first give you the general concept and then tell you how you might think about this in terms of the Fox Foundation. Many people bought life insurance to pay an estate tax. Many people bought life insurance to pay an estate tax when the estate tax exemption was a mere $1 million. While it's gone up to 11, be cautious because it may drop back to 5 million in the future, and that's what the law provides, that 5 million inflation adjusted is going to be the number after 2025. But if you have significant life insurance, so often people don't go back and look at it. They just continue doing whatever they did in prior years and paying for a policy. If you don't need the insurance for the reason you bought it for, look at your options. Now, obviously, I'll do a pitch that one of the things you could do is donate the policy to the foundation and help, a great cause in the process. But go through the full analysis. Does it make sense to keep the insurance? Does it still meet your current needs, especially with all the estate tax changes? Can you repurpose the insurance? There may be a way to change the insurance into a different insurance product and use it as a cash flow to benefit you or to benefit your heirs more early. Can you sell the policy into a secondary market? If you were in great health when you bought the policy and you've had a diagnosis of PD and now you're also on in years and you've been paying into the policy, it's a good quality policy, you may be able to get a substantial multiple of what the cash value of the policy is selling it into the secondary market. There's a robust secondary market for insurance. May be a great use. And the final one, which I mentioned earlier, is if you really don't have a need for the policy in any of these different variations that I've talked about, look at donating the policy. So keep in mind that you really need to review all aspects of your planning. Call your attorney, your wealth advisor, review what you have with them. Unfortunately, and I know it frustrates people terribly, gee, I did these documents, I paid for these documents, but the new law was a game changer, and depending how your documents were done, any level of the wealth spectrum you may be at, you may need to, at minimum, at least know what the changes are and how they affect you, but in many cases, you're going to have to update your documents. Now, in this slide deck, and I said in the beginning that I'm going to cover things that are relevant for all different wealth levels, there's a number of very technical charitable changes that were made. I'm going to mention them briefly. I don't want to dwell on them. If your estate is at either a wealth level or has the type of assets that might be affected, I just want to bring these changes to your attention because then you can go back and talk to your advisor. So if there's something you can do, you can address it. And for some, but probably very few of you, this could be really significant. For most of you, it won't be. But again, if we're going to talk about charitable giving, we want to cover some of these things. So slide 10, and I mentioned earlier I was going to do a little bit of repetition, but I think the changes are complicated enough that it warrants it. So the estate tax exemptions are doubled. Most people know charitable bequests will give any deduction. The standard deduction on your income tax return has also been doubled up to $12,000 per person, $24,000 a couple. Let me tell you on slide 10 what that means in numbers. The numbers that I've seen estimated are that before this change, so in 2018 when you file the tax return for 2017 for last year, 30 million Americans will itemize deductions. And I would suspect that the vast majority of those 30 million people will be getting an income tax deduction and benefit from charitable contributions. That number is going to plummet from 30 million to a mere 5 million. So think about what that means in terms of any incremental benefit for medical expenses, home improvements for medical purposes, or charitable contributions. Not good. Now, the numbers are disheartening to me on a personal level. Slide 11. So the doubling of the standard deduction is estimated by one source to reduce charitable giving by $13 billion a year. $13 billion a year. So if there's a way, and there's a bunch I'm going to give you in the next 45 minutes of our presentation, to get some tax benefits out of charitable giving, I want to, on a personal level, do anything I can to help fill that gap, because $13 billion of charitable gifts disappearing is going to do great harm to so many wonderful institutions that make our society what it is. The doubling of the estate tax exemption to $11 million is estimated to lower charitable giving by up to $4 billion a year. Big loss. So what we're going to do in the rest of this program is try to give you some creative ideas to help get more tax benefits and see if we can't offset a lot of these terrible projections and help you better help great organizations like the Fox Foundation. And I'm going to also occasionally mention some of the incredible non-tax benefits so that you can focus in a broader picture. So here's one of the technical changes. If you make a large gift to charity, and it's not large in dollar terms, it's large relative to your income, and more specifically your adjusted gross income, that amount was limited to 50%. In other words, the tax laws only let you give up to 50% of your adjusted gross income and get an income tax deduction. And again, that means you still have to jump over and get in excess of the $24,000 standard deduction. But if you're giving a large percent of your income to charity, if it's done in cash, they've now bumped up or increased, this is one of the few favorable things, to 60%. So for people donating large cash dollars as a percentage of their income to charity, you can actually give a little bit more. Very few people will be affected, but just do note that. There's some restrictions that were made on college athletic tickets, and there had been some leniency on when you had to get a contemporaneous written record from a charity on a donation, and that exception or those exceptions have been eliminated. What that basically means is any donation you make to anybody, you got to get a written confirmation and save it as part of your tax records. So technical changes, and we're going to cover some more technical changes that will be very important to some of the wealthier clients as we get on. Now, here's a concept that can apply it from, let's say, moderate income or medium level of income on up, and it's called bunching deductions. And this is a way that you can qualify to get some nice tax benefit out of charitable contributions and other deductions. So here's the concept, and I'll just take a couple of minutes to explain it because it's one of those sort of basic planning constructs under the new law. So let's say with this $24,000 standard deduction, you spend $5,000 a year on medical expenses and $10,000 a year on charity and $5,000 on taxes. So you're really just below the threshold. You're not going to get any deduction in any year for anything you do. Well, what if you did the following? Let's say in 2019, you accelerate deductions from you push off all the deductions in 2019 to 2020. So you would put off for a year making charitable contributions. If you have elective medical expenses that aren't urgent and can be incurred at any point in time, you push those off. The next year in 2020, you bunch deductions. So all the deductions you put off in 2019, you bunch into 2020. You incur not only your 2020 and 2019 deductions, but you accelerate into 2020 the deductions you would have incurred in 2021. So basically what you're doing is drawing all your deductions from a 3-year period into a 1-year period. You'll well exceed the hurdle of the $24,000 standard deduction, and you'll get a meaningful tax benefit from the deductions you incur. Now, how can you do it? Well, one of the things you may have a little bit of control over, and you have to talk to your accountants, there's a little bit of leeway when you can pay property tax or income tax and still qualify as a deduction. So there's a little play on that. Charitable contributions, if you make them every other year or every third year and bunch them into 1 year, that deduction will exceed the $24,000. So for example, if you were going to give every year $10,000 to the Fox Foundation, maybe the first year, and I'm sorry to say it, but it's the only way to get a tax benefit using this technique, you defer it for 1 year. You could still make a pledge so the foundation knows you're committed to the same amounts. But in the following year, instead of giving $10,000 for 2019 and $10,000 for 2020, you give $30,000 because you're bunching into 2020 the deductions or donations you would have made for 2019, 2020, and 2021. Now, many people will use donor-advised funds to do this. You can, and I've done this with lots of clients that have a particular charity they're looking to benefit. They may make the donation in 1 year to the charity and then have it dispersed over a couple-year period to different causes, programs that they specifically want to fund. So there's lots of ways to do that. So that's a concept of bunching deductions, and it's explained a little further on the prior slide. Let's go on to another planning topic. So bunching is one way to get deductions of benefit and tax benefit from donations and your medical expenses. Now, the next deduction or the next planning idea is a tremendous planning idea that will be incredibly valuable for the segment of donors that can use it. And this is something that's been available in the past, but the way the new law works, this will be the ultimate way for many donors to make their donations. So, what is it? If you have an IRA, the law permits, and it has for a number of years, and for years they went back and forth where it was a temporary change, then finally they made it a permanent change. You can give up to $100,000 of distributions from your IRA. So if you're married, you and your partner spouse, you can each give to $100,000, so $200,000 together. So whether you're high income or low income, this is a very meaningful planning opportunity. Even at the lower levels of wealth or income, here's why it works for all of you, from lower income to very wealthy. The money in your IRA, if it's donated directly to the Fox Foundation or any charity, that money will never hit your adjusted gross income. So in other words, the issue that we face with the new law with the $24,000 standard deduction soaking up and in effect wiping out, eliminating the tax benefit for most of your deductions is irrelevant to this planning, because money that goes directly from an IRA to the Fox Foundation never hits your income. So it's irrelevant. You don't have to get over a certain amount for a standard deduction. It's just off the table. So you get, in effect, the equivalent of a dollar-for-dollar income tax deduction without regard to the higher standard deduction for itemized deductions. Now, there's a number of requirements to make this work. The money really needs to go from the IRA direct to the charity. Now, the IRS has permitted somebody to get a check made out to, let's say, the Fox Foundation that you pick up and you can physically deliver to the foundation, but you cannot take a distribution, put it in your account, and then write a check. That won't work. And frankly, the example I just gave you of getting a check made out to the foundation and delivering it, I think, is a mistake. You're much safer and better off directing your IRA provider, and all the big providers are familiar with this rule and they'll all be able to help you, directly making a distribution to the foundation. So dollar for dollar, that's excluded from your income. Now, when does this work? You have to be over 70.5. Be careful. That's a little tricky because some of the IRA rules work. You have to be 70.5 during that year. That's not what this rule is. You have to be over 70.5 before you can do this. Not in the year, but when you make the distribution. So don't get it wrong. Second, it's got to go, as I said, directly from the IRA provider, the trustee of your IRA, direct to the charity. You have to make sure that happens. You need to make sure that this is an IRA from which you're taking required minimum distributions. Once you reach 70.5, you have to take certain specified amounts. There's charts, tables to look it up on. You can find calculators online. Every IRA provider, whatever bank, trust company, investment firm you're using, they all can help you with all of this. So if you're getting a $20,000 required minimum distribution out of an IRA and you want to give $20,000 to the foundation, you can simply call up your IRA provider. They may have a specific form you need to fill out, and most of them will have forms for this or a procedure, and they'll send that $20,000 RMD direct to the foundation. You've met your requirements for your IRA because you must pull out the required minimum distribution. The penalty for not doing so is a horrific 50%, so you're never going to take out less. So you can direct as much or little of your RMD direct to charity. Great planning idea. Now, under prior law, this was a great idea, but most people under prior law were able to get a charitable contribution deduction. So if you took the RMD, put it in your checking account, and then wrote a check to the Fox Foundation, it was probably almost the same. There was a little benefit because certain other deductions and things that were pegged to AGI, your adjusted gross income, would have been lower if you did this planning technique. But for many people now, this is the only way you're going to get dollar for dollar charitable contribution deduction. One of the best other aspects of this planning technique is that when you use these qualified IRA distributions, it costs you nothing to do. It's actually incredibly simple, even if I made it sound complicated because I was going through some of the requirements. And anyone who's providing for your IRA, serving as trustee, can help you do this. Now, let's go to another planning technique. Now, this is, again, something else that's been out there, and I'm just pointing out that it still exists, although it's not nearly as good as it used to be. So one of the traditional ways to donate to any charity is, instead of writing out a check for $10,000 to the foundation, you call up your broker or your wealth advisor, wealth manager, and you say, look, I want to make a $10,000 donation to the foundation. I'd like you to cherry pick the most appreciated stock that I own in my portfolio and ACAT, wire that over to the foundation. The reason that was such a great benefit is if you had a stock you paid $1 for that's now worth $10,000, that almost $10,000 of appreciation is not included in your income, so you have no tax, and you get a $10,000 deduction. Even if you don't get a deduction because of this standard deduction having been doubled, so now we're talking about the lower end of the spectrum, you still avoid all the capital gains tax on that appreciated position. So even if you can't get a deduction under the new law, this standard planning technique still works, only not as well under the new law. So don't give up on it. It's still a better way to do it. And if you haven't been doing that in the past, it's really a far greater way than writing out a check to a charity. And the dollars are just as good to any charity as coming by check or by an appreciated security. Now, here's another technique, and this is a little bit more complicated. You'll have to have your lawyer do this for you, and they can do it if you have to revise your will, which unfortunately I think most of you may have to do because of the new law anyhow. Here's the concept. If your estate is under the $22 million and you're married, or under $11 million and you're single, as I said earlier, because of these new high exemption amounts, you're not going to get any estate tax benefit from a bequest. So one of the ways around this that I said earlier, which everybody should do, is put into a power of attorney when they revise it the right for their agent to prepay or advance bequests under the will and maybe get an income tax benefit. Well, there's another way. So let's say you're planning even a bigger donation, and your estate's large enough that during the period of estate administration, your estate's going to earn income, and an estate will have to pay income tax like any other taxpayer. You can pay, or I'm sorry, let me say that differently. Your estate, you can direct in your will that your estate pay a contribution to charity, say the foundation, out of the income earned by the estate. So if your estate in its first tax year earns $20,000 or $100,000 of income, you could direct your estate to pay that income to the Fox Foundation, and the estate will get a full dollar-for-dollar income tax deduction against its estate tax return. Now, what makes this a little more difficult, and I need to clarify, if you're giving $100,000 a year and your estate's open for 3 years, that's $300,000. That's different than making a bequest of $300,000 under your will if your estate isn't paying an estate tax. What we're trying to do here is not save an estate tax, but get an estate income tax benefit from the donation. And this is very flexible. If you have a certain maximum amount that you want to give to charity, you can put a cap on it. You can have your lawyer be fairly creative in how they structure this. Historically, I'm not sure anybody, I don't know that I've ever seen in 35 years somebody make a bequest out of estate income, because there was no need to, because most donors got an estate tax deduction. And for most years, the estate tax was so much higher than the income tax, that was the better way to go. Well, for most Americans, the vast majority of Americans, no longer. And by the way, just to give you a sense of numbers, the numbers that I've read are less than 3,000 Americans will file an estate tax return each year, and I'm not even sure that's the number paying an estate tax. So with these very high levels of exemption, very few people will do that. Now, charitable lead trust is really for a much larger estate. It's not something, if you have a moderate or medium level wealth of an estate, that's going to necessarily make sense. But it can be used in lots of creative ways. One of the ways, and it's not on the slide, but just quickly to point out that I've used charitable lead trust. Let's say you're a parent and you have a child with PD, and that child, because of their PD, is going to stop working in 10 years based on their work life expectancy from their neurologist. You could set up a charitable lead trust for the child, and for the interim number of years, let's say you set up a 15-year lead trust. So for 15 years, the Fox Foundation could get an annuity or a unitrust, a fixed payment, and there's lots of different ways you can structure it, out of this pot, out of this lead trust. And at the end of year 15, the money can pass to the child. So if you're very wealthy and face an estate tax, this is a great way to make a large wealth transfer to a child, and it can almost duplicate or serve as a replacement for the earnings they don't have. So if the child has to stop working, estimated in 10 years, and you do a 12 or 15-year lead trust shortly after the child stops working, this transfer, and you can structure it so it uses zero of your gift tax exemption, is a wonderful way to provide, in effect, a income source, a retirement plan for that child. And one of the reasons that I like that kind of planning, let's say you have 3 children. One is facing health challenges, the other aren't, and so the one with health challenges you feel you need to give more wealth to help them get by. Here's a wonderful way to do it, because then you can still leave in your will a division of all your assets equally to all 3 children, so nobody's hurt and insulted. The piece that was done extra to benefit the child in need is done outside. Let's go back to the example on slide 24. So let's say right now the estate tax exemption is $11 million. And I'm going to simplify and get through this more quickly. Your estate is $8 million. Well, right now, if you have an $8 million estate and the exemption is $11 million, you don't face an estate tax. Now, if we were a little more sophisticated about it, if you project going forward the rate of growth and your budget and so on and so forth, very well may be your $8 million is going to grow beyond the exemption, depending on your rate of return. But leave all that aside. If you die before 2026, when the exemption is at $11 million inflation adjusted, your estate will face a zero tax. If you die after 2026, based on current law, your estate will face a pretty substantial tax because the exemption is going to be cut in half. What you could do is provide a bequest of the exemption amount to your children, for example, assuming no spouse, and any excess over the exemption could go into a charitable lead trust that could give, let's say, an annuity payment for 15 years to the Fox Foundation, and at the end of 15 years, then go to your children. Why would you do all that? It's a fairly creative, simple way to make sure you're paying no estate tax. You've given, under this scenario, if the exemption drops, $5 million inflation adjusted. So roughly, let's say, $3 million to each child outright on your death. It should probably be in trust, but whatever. And then 15 years after that, they're going to get the rest of the money to the extent that wealth grows beyond the annuity payment to the Fox Foundation. So you've in effect zeroed out your estate tax, given a big chunk of wealth up front to your children, and deferred the remaining piece and used this charitable trust that benefits the foundation to zero out the tax. It's a great way to zero out the tax, benefit the Fox Foundation, and deal with this potential change in the tax law in 2026. And if you do it more generally, the way I described, giving the exemption amount to your kids, the balance to a charitable lead trust designed to zero out the estate tax, it'll work whatever happens in Washington. So that's a great technique. Life insurance we've talked about earlier, so I'm going to kind of skip through it fairly quickly. The additional twist that I was trying to bring in here is most insurance is typically owned in life insurance trusts, so you need to go through the trust instrument with your attorney and find out what the instrument permits. So if you want to donate insurance that you bought that you no longer need and it's in a life insurance trust, you may need to distribute it out to the spouse or children, depending on what the terms of the trust are, and let them make the donation. You may be able to do a non-judicial modification, technical term, I'm sorry, where the beneficiary, the settlor who set up the trust, everybody agrees to modify or terminate the trust. Under Delaware law, which is incredibly robust, if the settlor who set up this insurance trust is still alive and the kids and everyone's alive and everyone signs off, you could do anything you want. So if you have an insurance trust with a valuable policy and you just don't need it because of all the changes in the law or the growth in your wealth with the market and so on and so forth, and you want to use that insurance to benefit the Fox Foundation, move the trust to Delaware, have everybody sign off, bam, you can take and give the whole amount to the Fox Foundation. I haven't thought through the income tax implications of that, but there's lots of different variations. The key take-home point, the mere fact that you have insurance held in an irrevocable life insurance trust, if you've determined that you do not need that policy, there may be lots of creative ways, even if the trust doesn't directly permit, to get that benefit to charity should you want. We've talked about advancements and paying bequests now, so I'm going to skip that. Let me take a few minutes and talk about a very different approach to planning. I'm going to do this first and explain it for lower wealth level clients. I assure you it can be a very creative way for very high net worth clients. And very high net worth clients, if you've looked at sophisticated trust planning to avoid, say, a New York income tax on the sale of a large equity position, you've probably used something called an ING, I-N-G, intentionally non-grantor trust. I'm going to give a simple variant of this that's different, that works for lots of wealth levels, and then I'll give you some other comments. This is a completely different approach to charitable giving that's ever been used before because we never needed it. But you saw the statistics of the incredibly negative impact the new tax law is anticipated to have on charitable giving, and we don't want that to happen because we need to support so many good causes. So here's a simple illustration. Let me give you a few defined terms real quick. A grantor trust is a trust that for income tax purposes, you, the person who set it up, called the grantor, pay the income tax. A non-grantor trust is sometimes called a complex trust, but what that is the trust, not you, pay the income tax. Most trusts that everybody has used for estate planning purposes, especially at higher wealth levels for many years, if not decades, have intentionally been structured to be grantor trusts because of all the various benefits. For the first time in many, many years, with the exception of the ING trust that I mentioned quickly before, we're now looking at non-grantor trusts to do lots of different planning techniques. So for charitable giving, let's say you have, you're giving I'll make simple numbers to illustrate. You're giving $10,000 a year to the Fox Foundation. You're never going to get a contribution deduction. I'm going to tell you a simple, inexpensive way you can set up a trust and get dollar for dollar tax write-off for your donation to the Fox Foundation. You set up a non-grantor trust. You set up this trust so you benefit the Fox Foundation, and you could add other charities, and let's say your children or other descendants. You put in $200,000 in marketable securities. Let's say for simplicity's sake it earns 5%, $10,000 a year in cash flow. That trustee, and you can name an uncle, a brother, somebody that's not going to charge you. It doesn't have to be a costly financial institution. Each year can give that $10,000 of income to the Fox Foundation. That income will be offset dollar for the $10,000 donation of income to the Fox Foundation. You've gotten effectively a dollar for dollar tax benefit. Look what this does on your personal return. You still have a $24,000 standard deduction, so you get the same status on your personal income tax return, which is great because you're not wasting charitable contribution deductions. And if you move $200,000 of investment assets, not IRA or retirement plan, to a non-grantor trust, those donations will be offset entirely and no income tax will be due. It's as if just by shifting it to a different bucket, this thing called a non-grantor trust, dollar for dollar you got a tax deduction. It's a very creative way to save income tax on your investment assets. Now, what if next year one of your children is buying a house and you wanted to give them the $10,000 for new furniture? Well, you just tell your brother who's the trustee, Joe, give the kids the money this year, we'll go back to the Fox Foundation next year. So you have incredible flexibility with what you need to do, and you've salvaged an income tax deduction. Now, on a higher level of wealth, we're looking at using non-grantor trust to maximize, and I apologize for the technicality, but I want to get the points across in the time we have. There's a new 20% deduction under Code Section 199A. That's just kind of what it's called for pass-through entities. So if you have a hedge fund, a real estate endeavor, you may lose that deduction if your taxable income is too high. So one of the things many taxpayers are looking at is shifting ownership or equity positions to non-grantor trust for children and others in order to maximize these benefits. So you can do this on a much higher level as well. The ING or DING, if it's done in Delaware, intentionally non-grantor trust for saving state income tax. You can do a variation of that, and I apologize for the technicality. I'm just trying to get points across that maybe you can take back to your advisors. In the past, all those trusts were done as incomplete gift trust. You can structure it as a completed gift trust, and the planning will work even in a state like New York, which has restricted that type of planning. So again, just to go back to our basic example on slide 32, if you put in, let's say, $250,000, I use 200, and you generate 12.5 of income, and you paid $10,000 to charity and gave $2,500 to your kids, you'd get a $10,000 contribution deduction, and the remaining $2,500 of income would pass out to your kids. You've salvaged your whole tax deduction. And on the simple level, it can be done with a fairly basic, not costly, local in your home state trust. Now, let's take a minute, and I've kind of thrown in a few comments for larger estates. Let me just give you a few more before we run out of time. Now, again, I'm going to go through these quickly, but the idea, as I said in the introduction, was I just want to give you planning ideas. You can go back to your advisors and make sure you're optimizing your charitable contributions and your tax planning under the new law. So let's take a look at some planning ideas. Now, I've given an illustration of a charitable lead trust earlier for just on, let's call it a moderate wealth estate of $8 million to avoid any estate tax if the exemption declines. Charitable lead trusts are a very powerful tool that can be structured to zero out, for transfer tax purposes, very large transfers. So you could set up a trust and let's use the same number, 15 years, And during the 15-year period, an annuity payment or a unitrust payment, a fixed payment, determinable percentage, or fixed dollar payment goes to the Fox Foundation. And at the end of 15 years, whatever the remainder is in the trust goes to your children in further trust. There's lots of variants of this. It's an incredibly powerful tool to leverage large wealth transfers, benefit a charity that you're trying to benefit, and so long as your rate of return is substantially beyond what the IRS tables provide for, the foundation will get in the intervening years a donation, and at the end there will be a substantial wealth transfer at no transfer tax cost. So that's something that's interesting. The second point. About a year ago, the IRS, the Treasury, had proposed very draconian rules, regulations, that would have eliminated, if greatly restricted or eliminated valuation discounts. And anyone with higher wealth estates is probably familiar with valuation discounts. The Trump administration deep-sixed these fairly early on. So right now we have an incredible window of estate planning opportunity. Doubled exemptions, and we can use that incremental $5 million or the full $11 million per person exemption to leverage very large wealth transfers when you have discounts that are available without these restrictions that we feared were coming into place before there's a change in the guard in Washington, which may or may not happen, but it may. So right now, for the next couple of years, we have an incredible planning environment to shift wealth to future generations. So when you engage in that planning, I'm sorry, I didn't mean to go on slide 34. And again, I apologize for being technical, but these are things that wealthier donors can take back to their advisors. One of the common structures for shifting wealth out of somebody's estate is you sell assets to a grantor trust, so there's no income tax cost on the transfer. You lock in the discounts, and you shift future wealth out of your estate, all the future appreciation. So if you have 40% of a business, that 40% will be valued at far less than 40% of the proportionate value because of the discounts. If that business is going to appreciate significantly, all that future growth will be leveraged out of your estate. But when you make large wealth transfers like that, you want to take precautions to avoid any possible gift tax the IRS could assert on a large transfer. And one of the approaches to doing that is to use something called a defined value mechanism, whereas if the IRS comes in and says, no, that wasn't a $100 million transfer, it's a $200 million transfer, the excess value needs to go somewhere where there's no tax cost. And for some clients, and if you feel a great affection for the foundation, that excess value, should it occur, could go to a public charity. And that's a very a sound way of trying to minimize the tax risk on large wealth transfers. So now is an opportune time to plan. Go back to your advisors if you haven't already and review that and look at using a possible donation to a charity in minimizing the tax risk associated with those transfers. So I think we have a wonderful window of opportunity. This is a very technical thing I just want to get across in case it affects you on slide 36. There are in excess of 2 million businesses, I forgot the exact number, organized as S corporations. While LLCs and various forms of partnerships are the most common entity, there's a very substantial number of S corporations. When you engage in estate and other planning with S corporations, you have to be very careful because only certain types of trusts can own interest in S corporations. The new tax law, and I'm not quite sure why they went about doing this, but the new tax law significantly changed the rules applicable to one of the trusts that can own S corporation stock. So if you have planning in place or are going to engage in planning and your business interest is owned as an S or structured as an S corporation, and it can be costly to liquidate, so you may not be able to change that if it's an older business into an LLC, the rules were completely changed for these trusts nicknamed SBITs, Electing Small Business Trust, which is one of the several types of trusts, limited number of trusts that can hold stock in an S corporation. Under prior law, trust rules applied to the charitable contribution deduction applicable to these SBITs, these special types of trusts. The new law has the rules applicable to individual taxpayers apply. So that could significantly change how you treat charitable contribution deductions in those trusts. And there's some more detail in slide 37. And that's something that you should, if you have an S corporation and you have any of it now in trust or going into trust, that's something to take a look at. Let's kind of pause and wrap up and talk about what we've done. Now, I apologize that some of what I talked about was very complicated and technical, and I also apologize, but it wouldn't have been possible in the hour to really dig in and explain in more detail what some of those complicated concepts were. But I felt it's important, because we're talking about charitable giving after the new law, to at least inform you of some of these changes, because if one of them affects you, you know to go back and at least ask your advisors about it. So again, I apologize I couldn't go into more detail, but I think alerting you to it was valuable. The biggest point to take home is charitable giving has to be different than it ever was. There's no reason not to secure income tax deductions from charitable giving. There's lots of creative ways to plan for charitable donations to benefit the foundation after this new tax law. Many of them are very different. It's almost like we have to kind of pause and rethink how we plan charity from everything we've ever done. For the vast majority of Americans, bequests, which had always provided an estate tax benefit, provide no benefit. But there's several solutions to that. Make an advancement under your power of attorney. I've had assurances from the Fox Foundation that nobody there will be upset if you prepay earlier a donation. They'll accept them earlier. The other approach, which is a little more complicated and on larger estates may be a very creative approach, is to use income earned by the estate to fund a donation. So bequests are now different. Your powers of attorney should be changed to make sure that you permit charitable gifts, because most don't. If you're looking to the more sophisticated planning because your estate is larger, you want to make other changes your attorney can advise you of, but be sure that you permit larger transfers to use these new exemptions if you're not using them now. The biggest change for many people is to use, for the first time in my memory as a planner in 20 or 30 years, non-grantor trusts. And it's a different approach, but again can be used from fairly moderate levels of giving all the way up. If you set up a trust that pays its own tax, you can have a charity as a beneficiary. Now, for the vast majority of people, given these very high transfer tax exemptions, I said 11 million plus per person, you don't really care if this is not an optimal use of your estate and gift tax exemption, because you're so far below the threshold, and it's a great way to get a dollar-for-dollar income tax benefit and still preserve the $24,000 standard deduction. Just as an aside, and I don't know how many of you live in high-tax states, but if you live in New York, New Jersey, California, the SALT deduction, state and local tax limitation that was enacted in the new law, is incredibly detrimental to everybody in a high income tax, high property tax state. I personally am taking my home, putting it into a limited liability company, an LLC, and giving fractional interest in that house LLC to various non-grantor trusts that I'm going to create, or actually convert existing grantor to non-grantor, to be more specific. And what I believe the result will be is each one of those non-grantor trusts will be entitled to its own $10,000 SALT limitation. So if you have 10 grandkids and you have a home in the Hamptons and you're paying $100,000 in property tax, you could set up 10 different non-grantor trusts, and those trusts could be used to hold 1/10 of your house, and you transfer enough investment assets to generate $10,000 of income to each. You should now be able to salvage the entire property tax deduction that the current tax laws have eliminated, or $10,000 is eliminated. If you're doing that, think of what happens if there's excess income in the trust. Why not permit charitable contributions? You'll get a dollar-for-dollar deduction as well. So I think we're getting near the end of the line. I apologize that we didn't cover general estate planning. There's another webinar that we did. The Fox Foundation will email you a link to. I've tried to give you an array of creative planning ideas under the new law to help you help the foundation achieve its noble goals. And I apologize that many of them were complicated, but unfortunately that's what the new law did. So, Michelle, if you want to pick back up, maybe we can try to wrap up.
Sure. I just wanted to, again, thank you, Marty, for your participation. I want to thank everyone who was on the presentation today. And again, you will receive an email with today's presentation as well as the one that Marty referenced, which was a prior one, early next week. And I hope everyone has a great day.
Thank you, everybody. Thank you for the opportunity.